We're up here.
We have clients that we've never met all over the world, so we
Okay.
can handle deductions.
Valerie,
I'm good, how are you?
I'm very well.
Okay, just, we would just scan everything to you.
Yep. We don't have to have originals, we don't have to see anything down.
Okay. Okay.
Start, fire it up, let's roll.
Good, you don't have to.
Did you announce it?
Introduce it? Where's that? I don't know exactly. Get my remote control here. Okay, everybody. What's everybody's favorite tax subject?
Our tax class is beginning right now.
Refunds.
Refund?
Refunds.
Oh, well, now wait a minute. To get a refund, that assumes that you have paid in some tax. Have you been
But I
making,
gotta feel that I ain't paid enough.
have you been making all your estimated payments?
Yeah.
You have? Okay, then you'll get a refund if you do everything I
No, I
tell you
won't.
today. Well, maybe sometimes it's good to owe a little money, that way they didn't have the use of your money while they're...
Exactly, getting refunds is a bad idea.
Well, it depends. Some people, they like it and some people don't. I usually try not to owe them any money. The penalties are bad. I'll talk about it now when we talk about estimated payments. You make your estimated payments. Don't do your own taxes. Don't cut your own hair. Don't take out your own
Is he local?
Even Albert Einstein didn't do his own taxes. Okay, the first thing we're going to talk about is the brand new tax rates. Did you know we have new tax rates this year? They just got passed. Okay, now you folks are all with Long and Foster. Now Elena's just starting out, but all of you. Oh, I brought this for Mike. This is magic.
Me.
Yes, it's for you. You should have one. If I have one, you should have one. How can I have it? Yes, I keep my old one. If it brings me good luck. Anyway, you folks all work with Long and Foster. You've been veterans for how many years have you been licensed? 7, okay. More than 5. How many years? 20?
I don't know.
30 something, yeah.
Less than one.
Less than 1. Another rookie like Melina. Oh my gosh. How about you?
19.
19? 28?
I got 26.
Okay, all right. So other than my rookies, well then all of you non-rookies, I know you're already in the $400,000 range. So that means you're in the high.
I guess I can leave now.
Okay, but let's just talk about somebody who's in their middle bracket. Now, if I went up to Melina and I said, give me 25% of everything in your wallet or everything in your bank account, you're going to say, no, I don't want to do that, right? That would be a bad thing. Well, this is what the government tells you, and all you have to do is earn $36,000 if you're single. And if you're married, you only have to earn $72,000 of taxable income. And they're going to take away 25% of anything over that. Now, if you make more, of course, you're in a higher bracket. But do you see it doesn't take much to be in the 25% bracket now? These are the new rates. These are the rates that are in effect for last year. They're new, but they started last year. They made them sort of retroactive. Okay? Now, you all have to file 2 tax returns every year, right? I'm assuming you're all Maryland residents like me. Does anybody live in Delaware? You or Pennsylvania? You could? Okay. Well, the Maryland tax rate's kind of high. What county are we in here? Hartford. Hartford, yes, of course. Yes, your taxes are higher than, well, the lowest is Worcester County, which is over in Ocean City, so they have low ones. But we have a county tax and a state tax. It ends up being about 8.95% of anything over a couple $100,000. But the minute you make $3,000 of taxable income, you go into the 8% bracket. To get to 8.95, you have to have a couple $100,000. But to make $3,000 taxable income, that's nothing, right? That's one sale, barely. Okay, so everybody here is at least in the 8% tax bracket in Maryland. Now, if somebody asks you about the other jurisdictions, you can tell them, D.C. is a little bit lower, and of course, Virginia is much lower. But in Virginia, don't all move to Virginia. You know why? Exactly. Every year, you have to pay a tax on every car, boat, airplane that you own, and it's based on the value. And also in Virginia, they tax all your food. We don't get food tax here, but they do in Virginia. So Virginia is not as low.
On the cars, once they reach a certain age, what happens?
So then they maybe just charge you $10 or $15 instead of $1,000. Okay. Yeah, but I'm sure you would drive a beautiful Mercedes or BMW.
My 2003 Odyssey.
You would pay something every year. But the good thing about the personal property tax is that if you're a realtor, which you folks are, anything that's associated with your car is deductible anyway. So they get that benefit. But if they're just regular employees, they don't get the benefit. Now, you folks all have to pay what's called self-employment tax. Now, Milena has a regular job. So in her regular job, I'll call it your civilian job, you pay half of the Social Security tax, which is 7.65, and then your employer pays the other half. But now that you're going to become self-employed, I'm going to teach you some of the bad news first, because then I'm going to teach you the loopholes. But if I tell you all the bad news first, then I know you're going to pay attention when I teach you the loophole, right? Okay, so the bad news is when you become self-employed, you pay both sides, and it is 15.3%, and that's kind of a lot. And it's even worse than that because it never stops. I can get out one that says it's dry erase. Are these dry erase? Yes. You don't want to ever use a permanent on a dry board. Okay, let's say that Milena, it's only her second year in real estate, and she makes $60,000. Yay, Milena, good job, right? And let's say that she comes up with $20,000 worth of business deductions. So what is her net income from real estate? Okay, 40. Now this 20,000 is just her car, her MRAS dues, her cell phone, her office and her home, things that she can deduct because she's in business. Then from the 40,000, we'll deduct, perhaps she has children, maybe she's got a marriage, she's got a husband, maybe she's got a mortgage on a home, real estate taxes. It's quite possible that by the time I finish your return, you're going to be way down here. You probably owe a tiny little bit of tax. But no matter what happens, on this 40,000, what tax does she always have to pay? Yes, how much is 15%? 15.3. It's about $6,000.
That gets paid before all deductions?
Yes, yes. Before any, very good, before all of your deductions for your home mortgage. In other words, even if Milena had 12 children, even if she owned 14 rental properties, maybe she owns a strip shopping center, she would probably owe no tax at all, but she's still going to be stuck with that $6,000 in Social Security tax. Now, some of us are older, and we might get Social Security, but you young folks don't count on it, and even when you do, it's going to be taxable. It's already 85% taxable, so it's really not such a good investment. Any of you who might be getting it, you might, you're lucky, thank God, and you earned it. It's your money, you're getting it back. It's not like you're giving you anything. So what I want you to be aware of is that your tax bracket on the money you earn from real estate is high. What is it? Did you add it all up? Now, this is assuming that don't stop being a realtor. I mean, the good news is coming in a minute. This is assuming that Milena is only in the 25% bracket. I mean, we might have somebody over here who's in a higher bracket, and guess what? This could be 35 up here. So now their actual tax bracket is 58%. All right? Now, the reason I'm telling you this news, hi, we have a boy in the class. What's your
We have a boy.
Another boy. What's your first name?
Sam.
Sam. Okay. So even if Sam might be in a higher tax bracket, and this would be 58%. Sam, to be in the 25% tax bracket, a single person only needs $36,000 worth of taxable income. A married couple only needs $72,000. So it doesn't take much. Now I'm teaching you the bad news so you'll pay attention. Now, think about this. Let's say that, what's your first name?
Tiffany.
Tiffany. Oh, pretty name. You should always wear blue. Okay, let's say that Tiffany is now that she's a realtor, she's thinking of spending $1,500 to buy a laptop. And she's debating whether she wants to spend the money. But Tiffany, when you buy that laptop and you deduct it on your tax return, you're going to get back half the cost. So that $1,500 only costs you how much?
So,
Exactly. Now, what would Mike like you all to spend money on? Marketing. That's right. Okay. Well, how much might a nice one, if you're going to send out a good newsletter, how much might it cost for sending out a newsletter? $300 or $400, something like that. Okay. So say that Mike would like you to send out a $300 newsletter. How much does it really cost you? Yeah, really?
And then with the generosity of London Foster, probably half of that.
Marvelous, even better. Yay, London Foster. I love London Foster. You folks made me $77,000 on a property I sold in 2004. Thanks to Beverly Posen in your Pikesville office. She sold me a townhouse for my daughter to live in for 3 years while she was in law school. Okay, estimated payments. This is important. It's important for all of you, but also you new folks starting out. Because you're not going to have any taxes taken out. When you get paid, you're going to get paid a check, okay? And it'll be the gross amount. So you're going to be required to pay your own taxes. So the government wants you to make 4 payments during the year. The first payment for this year is due April 15th. Come on, everybody, help me. When's the next one? June. Yes. Well,
January.
it's really January 15th, but a lot of times I have my clients pay them in December for the Maryland one. Very good, very good. Now, they don't just want you to pay your taxes quarterly and on time in the proper amount. They will penalize you if you don't. Now, the federal government charges 6% penalty and interest if you don't make the proper amount and if you don't make it on time. Maryland charges 23% penalty and interest if you don't make the payments in the proper amount and on time. So many times I'll have a client call me up and say, Linda, I had to pay for my kids' tuition, or we just had to put a new roof on the house, or our finances just aren't as good as they should be. I can't afford to make all the estimated payments that I'm supposed to do. So I always advise them to pay what first? Yes, pay the Maryland taxes first, because you're avoiding that 23% penalty and interest. The 6% of the federal, that's not so bad. I mean, your credit cards charge less than that. But the penalties and interest that you pay on making your payments late, unfortunately, is not deductible. No penalty is ever deductible. Penalty is like getting a speeding ticket, which I got a couple of months ago, but I got out of it. If you go to court, you usually get out of it. Wear something short. No. Anyway. And
I wouldn't advise it, Sam.
Sam, that won't work for you. But here's what happens. You take a copy of your record showing you haven't had any tickets for a long time, and they don't want to be the first one to give you a ticket, so you get out of it. Anyway, parking tickets are not deductible. You folks probably don't have to deal with parking tickets out here. But I do a lot of people from the Gateway Long and Foster real estate office, which is down in downtown Bethesda, where they have to pay parking, so they get tickets once in a while. And they're always asking me, why can't I deduct my tickets? I said, because it's a penalty. And we'll talk about penalties later when we talk about leasing cars. Okay. So any questions on that? Please feel free to stop me. If you have any questions, okay, then I'll just try right along. Let's look at the handout. Does everybody have a handout in front of them? I know a couple of them got saved. Does everybody have a handout? First of all, rip off the first page. Oh, look at you. You already did. Oh, amazing. Oh, and beautiful handwriting. Oh, you can tell you're raised in Europe because you have that European style. It's beautiful. Yes, I went to school in Switzerland as well. They tried to teach me that way.
Yeah. How do you determine the amount to pay on your estimated payments?
Very good question, Tiffany. Your tax accountant will tell you. Now, the first year is based on what you did the previous year, and every year thereafter is based on the previous year. But there are 2 ways of getting out of the penalty. As long as you've paid in as much as your entire tax bill was the year before, let's say that your whole taxes for the year before were $4,000. So as long as you paid $1,000 every quarter on time, even though you still end up owing money at the end of the year because you made more money this year, you can get out of the penalty as long as your income is under $150,000 and we go to Plan B. Okay? Good question. Now, look at the second page. We already ripped off the first page. By the way, the main reason to give you your name and email address is everything I'm teaching you today could change tomorrow. And when it does, or if it does, we send out a newsletter. It's about a 1-page newsletter. My son Preston, who actually runs the office, he sends out a newsletter. He sends out one 4 times a year to remind you to make your estimated payments on time. Gosh, one time I got one, and I would have forgotten if I hadn't gotten the newsletter from my own son. Thank you, President. Thank you. Anyway, plus there are going to be some tax law changes, but we don't know when, and probably not till September. Anyway, let's see. Realtor deductions. Do you see all these juicy deductions on here? When you go to your tax person, it doesn't have to be us. I'm not here to advertise. I just want to educate you. But when you go to see your tax person, I know Jane told me that she and Robert are very attached to the tax person they're using. But at least, Jane, if you fill out all of these juicy little things, and there's a couple on here that I want you to make note of. You see where it says, well, we'll go to the next thing here. We'll talk about it as an example. Examples always mean more than anything. The $25 rule. I covered this last time when I was here, and I've got a new loophole on it. Oh. When you ladies want to give a gift to your client, perhaps it's a settlement gift because they bought a home from you, or maybe they referred somebody to you, you're allowed to give them gifts. You can give them anything you want. However, for tax purposes, you're only allowed to deduct $25 per person per year per married couple. That's awful, isn't it? Now, if you sell a house to an unmarried couple, whether they're same sex or opposite sex, then you could deduct $50 because they're not married, okay? Now, that's the rule. Like the loophole. The loophole is that if you give them something that's connected with the sale, what we call it is a client accommodation. You see that up on here? Client accommodation. For instance, there's a warranty. Our warranty is about $420 now, something like that. So perhaps you've told your client, you know, if you buy this house, I will throw in a warranty for you. Well, that's more than $25, but it's connected to the getting the deal through, right? Sort of like you're greasing the wheel. Or you veteran ladies, how many times have you gone to the inspection and the dishwasher doesn't work, or the screen door won't close or something? And who out of the kindness of their heart offers to pay for this?
Yes.
Yes, of course you do. And that comes out of your commission, or you write a check to pay for it. Either way, that's deductible, because that is something that was necessary for the deal, right? It wasn't just a gift.
The whole amount, no matter what it is?
Yes, no matter what it is. I mean, I've had clients where we're talking $1 million houses out in Potomac, and they've put in a new washer and a new dryer, or a new refrigerator. You know, something really big. Okay.
So does Logan Foster flat fee?
Yes, yes, absolutely.
Sometimes you get
Yes.
stuck with it.
Yes, absolutely, absolutely. No problem. Put that down here. Okay? There's probably a little place for it, fees or something else. We'll find one. If not, it's a client accommodation.
So you can deduct every flat fee that you...
Yeah, admin fees, I think we call them admin fees.
Well, they're calling it flat fees because admin fee, that was another loophole.
Oh,
We can't call it.
okay, we'll call it
Right.
anything you
Correct,
want.
you can't call it admin fees.
Okay, it's not admin fee.
No,
That's what
no.
we used to call it.
Yeah, now it's flat fee.
Flat
What
fee.
do you call it? A flat fee.
Flat fee is fine. I like that one. Okay, now that's...
But they're still on that.
There's another rule that says that you're supposed to have a receipt for every deduction, right? Can't your accountant or your IRS agent, if you get audited, ask you to show a receipt for everything you paid? Sure they can. There's one exception to the rule. If your expense is $75 or less, you're not required to show any receipt. You're only required to have written down the date it happened, the amount that you spent, and the business reason. I always use this as an example. Let's say that Tiffany is going to have an open house this Sunday, and it's a house that the people, let's say the people have already moved out, so it's vacant. And as she's driving to the vacant house, she starts thinking, whoops, I better stop at the grocery store and pick up, or the Wawa, and I better pick up some things to take with me. What do you always take to an open or a vacant property?
Gun.
Oh! Yes, okay. Well, 30 years ago, I used to do real estate. I got a real estate license when I was 18, and I got a broker's license when I was 21, because I kept the books of a real estate company, and the broker, when I was working there, said, you know how our heart beats, you should have a license too. So he showed me how to sell buildings. I sold commercial and industrial properties. I sold the Chevy Chase Medical Building twice before I was 21 years old. My father was a doctor. It helps to have a father who's a doctor, because then they introduce you to their doctor friends. Anyway, in any case, I made enough money doing real estate that I said, I never want to do real estate again, because what you do is really hard. So as soon as I got out of college, I opened up Tax Masters with all the money that I made, and I've never looked back since. But I know how hard you work, and I know what it's like when you go to an empty building, because I used to carry these lights in my trunk, and I used to carry toilet paper.
Oh,
This is the
I know
one
that.
thing. Yes, if you're going to have an empty house or a vacant property, you take toilet paper.
That only happens to you once.
That's right, and you remember. Very good, Jane. All right, so maybe it's going to not smell so good, so you want to get some candles to take with you, or maybe you're going to make some chocolate chip cookies and you get those things and you put them and you're going to cook them, and you have them all come to your open house because I love them. So now you've spent a whole bunch of stuff at the Giant or the Wawa, and you have this long receipt because you bought maybe 8 or 10 things, for your home. But you don't want to have to take this receipt and circle, this was how much for the candles, this was the toilet paper, this was the bottles of water. No. So you just write down in your day timer on this calendar, somewhere, write it down. $60 supplies, open house. Now you get there, and oh my gosh, the yard is a mess, the garage is a mess, so you get the little boy next door to come over.
Oh, no. You do it yourself.
Well, let's just say, hopefully, there's a little boy next door, and you give him $50, and he shovels the snow, or he mows the lawn, and he tidies up the garage. Now, does he have receipts that he gives out? No. So you write down the date, the amount spent, $50, the reason, tidy up the house. Okay? So at the end of the day, you've got $60 in supplies and $50 for the little boy. You can deduct all of that. Why? Because each of them was less than $75. A couple of weeks ago, we had a new client come to our office, and she had made about $80,000 from real estate, not a Long and Foster agent, otherwise she would have been more organized. She had open house expenses, broker's office. There was nothing written on this line whatsoever. Now, she was sitting with somebody. I don't actually do returns, so she was sitting in the office across from me, and I was listening to her talk to Tom. Tom is wonderful. Tom is an enrolled agent, just like my son. That means that they both passed an exam given by the federal government that allows you to do taxes all over the United States of America, and they're really good. And so Tom was explaining this rule to her, and he was saying, well, why don't you have any brokers open or open house expenses? He said, are you a buyer's broker? Because usually buyer's brokers, they don't do open houses, right? Yeah. So she said, no, I'm not a buyer's broker. She says, I do 2 open houses every month. So he explained the rule to her, and she said, that's it. She says, I know I spend $74 on every open house. He said, well, if you can go back and write that down with the date and the amount spent and what it was for, that would give you 24 times a year, 2 times a month, 24, times $74. You know how much that is? That's $1,800 deduction. He said that would save you about $900 in taxes. She says, oh, let's go fill in some more lines. So then she wanted to put something in another. So Jane and everybody else fill in all these little spaces. Yes?
How did you know I had a question? I didn't have my hand up. I do. Somebody was talking about an app on the phone where you can just take a picture of
The receipt.
Yeah, is the IRS accepting that?
Mm-hmm. Yes.
You don't
yes.
have to keep a paper receipt? Or
That's
something?
fine. That should be fine. I don't think there's any problem with that. You know, in my office, I have 2 former IRS revenue officers. Yeah. Doesn't Gene look like he worked at the IRS? He's so cute. He gets rid of liens. If you have someone who's got lien problems.
Well, that's why we don't get rid of our account. It seems to work for the IRS.
Oh, okay. Well, that's like Gene. And I also have Steve, who used to work at IRS. He was a revenue officer also. Actually, Steve also worked on fraud cases where they go in and take people's boats and airplanes and the drug dealers and things. Steve is very patient. He has an autistic son, so he's very good with people who haven't filed for many years and they have a lot of tax problems. He's really good. They're both good. If you have any questions on whether that receipt would stand up, you can ask Steve or Gene in my office. They'd be happy to tell you.
It's a shame to take a whole year of receipts and then they're not going to accept it.
That's right. So ask them for sure. That's a good one, but it's better than nothing. You two pay attention here. I am a tax accountant, but in the summertime, or whatever is necessary, I make a lot of money being an expert witness for realtors who've been sued. Now, why is this? Because I'm an accountant, and I'm also a real estate broker in the state of Maryland. My broker's license is 901. That's how many years I've had it. Well, it's 0901. Anyway, you are never, ever going to tell a client that they will get a deduction by buying a property or that they will get some tax shelter by buying a property. You have to be very careful never to give any tax or business advice. You tell them always, please talk to an accountant who specializes in real estate tax law. Don't just say, talk to your accountant. Because many times people have an accountant who knows nothing about real estate tax law. The accountant gives your client the wrong advice, and then, I've seen it happen, I've been the expert witness, who gets sued when something goes wrong? Do you think that your client sues their accountant? They play golf with their accountant every Saturday. No, they sue you for not telling them that their accountant was wrong. This happens every year. I get 3 or 4 cases like this. So what I want you to be careful of is when you're dealing with everybody, but particularly investors. Now, how many of you would like to sell a property to an investor? Would everybody put up your hand? Investors are great. I used to deal with investors. If they like you, they'll buy several properties from you. If somebody buys a house from you, Milena, they'll probably just live in it for 6 to 10 years before they need you again. But if you get an investor who's going to buy properties, sometimes they'll buy 3 or 4 or 10. All right? So I want you to be careful on this one. In 1986, this law was passed, and it seems like many realtors don't know it. This law says that if your client makes $150,000 or more, that's their adjusted gross income, they are not allowed to deduct on their tax return any losses from owning rental real estate, no matter what kind of rental property they own. Nothing. Now, you folks are considered real estate professionals. Not the 2 of you yet, because you have to be a full-time realtor, and more than 50% of your income has to come from real estate. You cannot have a 40-hour-a-week job doing anything else. You have to be full-time. Now, let's say that Sam has a nice young couple, or maybe not so young, but the husband makes $75,000, he works for the government, and the wife makes $75,000, and she's an engineer. So their adjusted gross income, front page of their tax return, is how much, Sam?
150.
That's right. So you will never tell these people, oh, you should buy this townhouse because it's going to give you some good tax shelter. No, because when they buy that townhouse as an investment, they are not going to be allowed to claim any immediate tax deductions from all the expenses and the depreciation to which they're entitled, because their income is too high. Now, if their income were to drop below $150,000, they could get some of it. So until one of 3 things happens, you are not allowed to claim any losses from real estate. This means your income either drops below $150,000, or you sell the property, or the next one will get you a commission. If they buy another property, and another property shows a profit, then the loss from the first property can wipe out the gain from the second one. You got it? Okay. So don't get stuck on that one. How about your vehicle? Oh, let's talk about cars. Let's talk about cars. Oh. And everybody wants to know whether we don't want to talk about we're going to lease or buy or anything. First, pull out the handout and look at the car deduction thing. What do you get to deduct with your car? Everything, just about. It's really important to know about your car. Your car is the largest deduction you will have when you work in real estate. It really, really is, and it's an important one also. That's not mine. Oh, did I use it already? There it is. Okay, let's say that, let's type that Sam. Sam tells me he drives 20,000 miles a year. That's 100% of Sam's driving. Now, 10% of the time, which is 2,000 miles, he's having fun. What are you doing the other 18,000 miles a year, Sam?
I'm working.
Of course, he's working. So Sam has 2 ways he can choose to deduct his car. He can either take 90% of all the expenses on this sheet. What do they include? The interest on the car loan. Did you know that? Now you can deduct the interest on your car loan because you're self-employed. You can deduct the warranty on the car. Always you take your car to the toll. Your car washes are deductible. Auto Club membership, AAA. How about gas, oil, lube, repairs, tires, towing, and oil? Everything that you spend on the car, Sam, you can take 90% of it. Or if Sam says, no, I'm just too lazy, I don't want to keep track of my insurance and my repairs, then you can just say, fine, I'll take 18,000 miles times the cents per mile. Okay, what is the cents per mile? This year, for 2014, it's 56 cents even. Last year it was 56 and a half, so it went down a little bit. But no matter which way you claim your car, whether you claim the 18,000 miles times the 56 and a half cents for last year, or whether you claim the 90% of all your expenses, you always get to claim your car loan. Now, how does this work? You would just take 18,000 miles times 56.5 cents per mile, and to whatever that number is, you'll add 90% of the interest on the car loan. Did you know that?
No.
Nobody knows that. And it's been around a long time. I have never, ever seen a tax return done with that number included in it. It wasn't done by our company. Tax man. Yeah. Nobody knows it. Okay?
That's even if you take your mileage, you can take off for your car.
Yes, the interest on the car loan. Nobody knows it. It's another loophole. They call me loophole Linda for a reason. We still have the law that says that if you want to buy a really big car, like a Toyota Land Cruiser or a Cadillac Escalade, you can deduct up to $25,000 the first year. Now, let's talk about leasing a car. Oh, Melena, hold that up for a minute. Okay? Does anybody want to know about leasing a car? If you want to lease a car and you're my client or you're somebody I love, and I love all of you, not just because you're with Long and Foster, but I love you because you let me come up here and talk to you. You have to jump through a hoop if you want to lease a car. The first hoop is somebody like Milena. She's a rookie. She's just starting out. She's only 22 years old. And all she has, hi, we have room for you too, even though you're big and tall.
I love your props. You got so many props.
You can for the hoop even.
Here we go.
Melena's only 22, and all she has is the old car that she drove back and forth to college. But now she's going to be a realtor. She needs what does she need? She needs a safe car that makes a good impression on her clients. So Milena, you have my blessing. You may go out and lease a car. Then we have somebody like, what's your first name?
Mary Beth.
Mary Beth. Is it Mary Beth?
Yes.
Yes. So somebody like Mary Beth, who's not old.
Oh, yeah.
a veteran, experienced realtor. Okay, and she's going to promise me that she's always going to be at least in the 28% tax bracket. So as long as you're in the 28% tax bracket, you have my blessing. You may lease a car. Here, you have to hold up. Okay, so we have those two. Anybody else? I prefer. Oh, let's watch out for the coffee.
I'm okay.
Yes, I'm
It's
sorry. There you go. I'll take it now. There you go. Then you two have my blessing. Anybody else? If you don't fit into one of those categories, it might not work as well. Now, there is one downside on leasing a car. I lease my car, but I don't drive as many miles as you folks do. I only drive about 12,000 miles a year. How much do you drive?
20.
Yes, of course. Okay, well, when you lease a car, they usually want you to drive no more than 10, 12, at the most 15,000 miles per year. So many of my clients, they go ahead and lease anyway. And then at the end of the lease, they call me and say, oh, what am I going to do? There's a big penalty that you have to pay at the end. And I tell the client, it's simple. Don't pay the penalty. And they say, well, what am I going to do? Am I going to leave town? It's going to ruin my credit. I have to do something. I can't steal the car. I said, no, I forbid you. You are not allowed to pay the penalty at the end of the lease. What I want you to do, what you must do, you have to do what I tell you, you must buy the car from the leasing company. Then you can either sell it or keep it a little longer, maybe whatever you want. But if you keep it and use it, fine, we'll depreciate it because you bought it. But when you sell it, if there's a loss when you sell it, that loss is fully deductible the year of sale. Now let's think about it. The penalty that you had to pay, was that deductible?
No.
The loss when you sell the car, is that deductible? Yes, the whole thing. Not just limited to $3,000 or anything. It's all deductible. Let's see, which is better? You have to remember something. Linda is always right. You know how I know this? You just ask my 5 ex-husbands and my fiance. They'll tell you Linda's always right. Hey, I still do their taxes. Well, the ones that are alive double time. Okay. Office and home expense. In 1999, who makes the tax laws? Congress. In 1999, Congress told Internal Revenue, that's Internal Revenue over there, doesn't that look like Internal Revenue? Internal Revenue, you are forbidden. You may not audit anyone who claims office and home. That's been the rule since 1999. You don't have to believe me. You can ask wonderful Gene, he was there at IRS back then. You can ask Steve, he was there at IRS too. They have never seen an audit of office and home, ever. Doesn't happen. They do not audit it. We've never had an office and home audit since 1999 when the law changed. If you read in the Washington Post, you read in Kiplinger's, you read in Money Magazine, you read all these places, oh, red flag, office and home. They're wrong. They're idiots. They haven't read the law since 1999 when I helped get it changed. That's another story. We won't go into that. Anyway, the rule is that as long as you use the space in your home, can you see that where it says regularly and exclusively? Then you're allowed to take some office and home deduction. Now, how many of you have a file cabinet at home for your business stuff? Put your hands up really high. Okay. Mike, if all these people decided tomorrow that they don't want to have an office in their home, they want to bring those file cabinets to your office, what do you say?
It's already here.
It's already here.
You're supposed to say no. No, right?
We keep trying that.
Okay, then here's the deal. That entitles you to claim an office in your home for the administration work of your real estate business. This is where you pay your bills. Where do you keep your personal tax records? Home. Okay, well that's your personal tax record. They include your Schedule C for your business or your corporation. You happen to be one, okay? It doesn't need to be a separate room. It can be part of a larger room, like mine is. You don't even need to own your own home. Melena, she's only 22 years old, and she just rents an apartment. But she uses 10% of her apartment for business. Well, then we'll deduct 10% of her rent and her utilities and all of the things that go along with owning a home. Isn't it here? Yeah, your mortgage interest, your real estate taxes, insurance, repairs, utilities, cleaning service, your maid service if you have one. Everything becomes deductible, a percentage of it, depending on how many square feet that you use. Okay? Now, here's the big deal on claiming an office in your home. If you don't claim an office in your home, don't even think about claiming a lot of car expense. Because if you don't have an office in your home, is your first trip of the day deductible? No. If you have an office in your home, if you're like me, I get up in the morning, I turn on my BlackBerry, my iPhone, I play with my laptops or my desktops. And then I jump in the shower and I get dressed, and then I go over and I do a TV interview or a radio interview, or I come and I teach a class like today. I love being here. Then my first trip is deductible, isn't it? Yes. And then as I'm driving home, I always go home and check all my stuff, right? My mail, maybe there's a bill in there, there's something to do with business. Okay, that makes my space deductible. You have the same reason. Now, we are right now handling 11 audits. These are not our clients. We haven't had any clients audited. Last time I had audited was 4 years ago, and he's a lawyer. He makes $7 million a year, and they audited his boat and his airplane. Okay, so they're not auditing our clients. We do 3,000 clients every year. 80% of our clients are realtors or investors or developers, something to do with real estate. Unless we have the doctors and the lawyers. But anyway, we have 11 new clients who are being audited in the past couple months. They're all realtors. They all either did their own tax return or they did it like on TurboTax. By the way, TurboTax, what does it cost, like $100? The program that I buy for our company every year costs $18,000. I spend $18,000 a year. Now let's see, which one do you think does a better job on your tax return? The one for $100 or the one for $18,000? Mine, of course. So anyway, these people did their own returns, or they went to another accountant, and they claimed, these realtors, they all claimed between 75 and 85% business use of their car. That doesn't seem like an astounding amount, does it? No. But you know what? IRS says no. They did not claim any office and home. Therefore, it's impossible that they use their car that much for business. So IRS is auditing them. Why? Because they didn't claim an office in their home. How do you like this? Yes, got it? So you know what Gene and Tom and Steve, they're the ones who handle the audits. What they're doing is they're opening up the file, they're putting in the office and home expense for the last 3 years, because we can go back, and they're memorializing all the driving, which came out to be more like 90%, right? Because now we're doing the office and home. So all of these clients are getting back $3,000 or $4,000 or $5,000, $6,000 worth of refunds. How's that? Plus, they're only paying us $1,000 to handle the audit. Now, when you pay your accountant money, how much does it really cost you? It's deductible, right? So, if you write a check to me for $1,000, it only costs you $500. Now, I'm getting these people back, or they're getting these people back, all these refunds, which aren't taxable, by the way. Refund from the IRS is not taxable. Isn't that neat? So don't not claim an office in your home. Okay? When you sell the house, we do recapture the depreciation, but it's tiny. Let's just say that for the next 10 years, I do Sam's return, I'll deduct approximately $3,000 a year for your office in your home. So at the end of 10 years, how much have I deducted?
30,000.
Right. How much the tax did it save you? 15,000.
Well, half.
15,000
Right.
in your pocket. I gave you 15,000 in savings. At the end of 10 years, I'm going to have to ask you to pay back about $960. Is that okay? No, you don't mind? I'll put my hand up for $960. You better make that deal.
Yeah.
Otherwise, okay, do it. It's a good deal. Now, how many of you know that there's a law that you have to own your house 2 out of 5 years, or 24 months out of 60 months, right? And you can get an exemption. How much if you're single?
250,000,
And if you're married?
500.
That's right, but there's a loophole.
What's that?
The loophole is really neat. The loophole says that if you have a compelling reason for selling your home, you can sell it before the 2 years are up, and you can still take a portion of the a portion of the exemption. When my son Preston was single, he used to buy houses every 2 years. He's Mr. September, because he was born in September. Where's September here? When Preston was single, he'd buy a house every 2 years and fix it up and sell it. And that was no problem. He could exclude up to $250,000. Well, he never had that much gain, obviously. You don't make that much in 2 years, even no matter what you put into it. But then when he and Katie got married, they promised that they would start a grandchild for me within a year. Well, 1 year and 1 week later, she got pregnant. And then they needed a bigger home. But if they had gotten pregnant with twins, they could have sold the home within just the first year and still excluded what? What could they have excluded? They only lived in the, say they lived in the house 1 year. So 1 year is half of the 2 year requirement, right? Right? 1 year is half of 2. So that means they could have excluded half of that. How much gain could they have had? Yeah, they didn't have that much, but they could have. Now, she didn't have twins. She did have a little boy, another little Preston Oxley. He's so cute. But you may have a client who's been transferred, or they've lost, oh, God forbid, they've lost their job, or they're getting a divorce, or medical reasons. Maybe they're in a 2-story home, and because they're very heavy, maybe they need a 1-story home, so they don't have to walk up and down the stairs or something.
What's the Brady Bunch?
A Brady Bunch, let's say that when Preston married Katie, he owned a home for a year, and he married Katie, and she had children from a previous wedding or marriage or something like that, or relationship. Then that would qualify. Okay? So just here's the deal. This is how I help my clients. Because many times I'll have a realtor call me up and say, Linda, can you help me on this one? I have a client, they've owned their house for a couple months, and now they want to sell it. And they think they have to wait for up to the total 2 years before they can sell it, which means that my client has to wait 2 years before she can get her commission. That's right. I don't want that. I don't want my client to get her commission today. So I said, well, let me talk to them. And I try to find one of these reasons that will fit. And very often I can find a medical reason. Medical reasons work really good, because I have a couple hundred doctor clients. We get certifications, but only real ones now, only real ones. Okay, the Mortgage Forgiveness Act, I'm not going to cover this one. This is a big mess. I covered this one pretty much in detail last time I was here, but we don't know if they're going to renew it or not, and it'll give me an excuse to call up Mike and say, please, can I come back and talk for you anyway? Any of you who dealt with short sales and foreclosures back in the old days, you might have some repercussions. Okay, this is the second to the last subject I'm going to cover today, and then I'll stay and answer all your questions. Every year, ABC television and sometimes NBC or CBS, but always ABC. They send a photojournalist to my office, and a cameraman and everything, and so it's a whole troop of them. And every year they do an interview with me that they show on the news, and every year they ask me the same question. What do you think that question is? Linda, what's the most overlooked tax deduction in the whole tax code? And every year for the last 17 years, I've talked about the same subject. Now, if they don't realize it's always the same thing, so they send somebody different every year. But anyway, in 1953, Congress passed a law to help husbands and wives who work together. Who were they? Farmers. Farmers. Don't husbands and wives who work together on a farm? They're like a team. They're like their own little company, right? Okay? All right. They thought it wasn't fair that if you worked for a big company, you would get free health care, at least back in those days, and you would get to deduct all of your insurance and things like that because it was paid for by your company. So they said, we need to give that same benefit to married couples who are both self-employed. This law's been around since 1953. It has never been lost on an audit. I've never even seen it audited on the East Coast. It was audited on the West Coast a couple times, and they lost both times, so they gave up. All you have to do is have a married couple. I'm going to use Jane and Robert as an example because she said I could. If you're both self-employed, it works the best. It also works fine as long as you're just married. If you're not married, it also works fine that we have to make you a little C corporation, that's all. What does it mean? You hire your spouse, and if you're a C corporation because you're single, who's single here? I need somebody who's single. Who's single? Mary Beth. Okay. So Mary Beth, you just form your little corporation. A little corporation. It's the Mary Beth is Beautiful Corporation, or Mary Beth Finds Beautiful Homes, something. And you say, well, I'm the president of my corporation. I think I should give the president of my corporation a medical reimbursement plan because my president is such a good lady, don't you say? Yeah. Okay, so you give yourself a medical reimbursement plan. So every once in a while, you have to write yourself a check out of your corporation, which is fully deductible, to reimburse you for all your health insurance and your medical bills. Or what Jane will do is every once in a while, her husband will come up to her and Robert will say, hey, boss. You know?
Really?
Yeah. Well, he can hire you. Either way, it doesn't matter. But let's say you hire him. Hey, boss, you know, my wife is very expensive. She just spent $1,000 on new glasses, and I just spent $1,000 on a dental bill. So I need to get reimbursed. So Jane, out of her business checking account, which is another thing I need to tell you about, maybe you should have a separate checking account for your real estate business. Out of her business checking account, writes a check to Robert for $2,000. She deducts it as an employee benefit program. He puts the $2,000 in their joint account. He's not going to go spend it at the track, is he?
No.
Okay. So now, what was before a non-deductible expense becomes a fully deductible business expense. Can you ever deduct medical bills normally? Say no. Say no.
No.
You can't deduct any medical bills unless they exceed 10% of your income.
How much? I'm sorry, Coffee, how much is it?
10% of your income went up this year. Unless you're over 65, then it's still 7%. So let's say we have a married couple. They make $100,000 a year. What's 10% of it? $10,000. If they have $9,000 worth of medical, how much can they deduct? None. If they have $11,000 in medical, how much can they deduct? That's it. No. Only the amount that exceeds 10% of their income. Okay? So basically, nobody gets any medical deductions. But if you hire a spouse or become your own little C corporation, now you can deduct all of your medical bills as a fully deductible business expense. Do you know what I've just done? That's alchemy. What I've done is I've taken non-deductible personal expenses and I've made them fully deductible business expenses. How much does a business expense save you?
Yeah.
At least half. Half. If you're in a higher bracket, way more than half. I lost my thinking. Here we go. Okay, so you hire your spouse. We charge $600 to set up the plan. Marty in my office does more of these medical reimbursement plans than anybody in the United States of America. Okay, now if you pay him $600 to set up the plan, that doesn't include your tax return or anything. How much does it really cost you? $300. For that, he does the W-2 form that you're going to give your husband at the end of the year, or your wife, whoever it's your wife, and he does all the withholding, all the payroll statements, everything is included. That includes an actual contract. In other words, this is not a scheme or a scam. You are hiring somebody just as if you were hiring a stranger. They have to file an employment contract. We provide you the contract. We have to prove that they're allowed to work. We have to fill out an I-9 form for the Internal Revenue Service or the government to prove that they're either a citizen or a resident allowed to work. It's all done. There's a lot of paperwork. That's all included, okay? Now, guess what? During the year, you reimburse your spouse for all your medical bills. And I'm talking medical, dental, glasses, insurance, any out-of-pocket co-pays, whatever it was, prescriptions, anything prescribed by a doctor. Every bit of it is fully deductible business expense. This is the most overlooked tax deduction in the whole tax code. I've been doing it for 30 years. Most recently, I had a gentleman come to see me. This is such a sad case. He has 10-year-old little boy twins who both have asthma. He was going to an accountant down on Capitol Hill. He heard me I was on Sirius radio in January 21. He heard me on Sirius while I was driving around. So he said, he heard me talk about this. So he came in and he said, my accountant never told me about this. Is this a new law? I said, no, it's been around since 1953. He says, well, my wife is a stay-at-home mother, and he makes a lot of money. He makes like $300,000 a year. He said, we spend at least $10,000 a year on all the medications and doctors for my twins. And he also spends another $20,000 on insurance and everything. He spends like $30,000 a year in medical bills every year, which he's never been able to deduct, right? Because he makes too much money. Guess what? For the past 10 years, how much is that? That's 10 times 30,000. $300,000 that he lost in tax deductions because his accountant didn't know about a law from 1953. Okay? So needless to say, he paid the $600. We're going forward. You can't go back. You're not allowed to go back and change anything. You only start from the day you hire your spouse. It's too late to go back. Yes?
You keep saying C corporation, and I had one at one time. And
I don't like them necessarily, but if you're single, it's a great idea for deducting medical bills.
I guess that's why they set me up in it. But I talked to at least 3 other accountants that all said, why? Why don't you have an S?
Because they shouldn't know. You can't do an S corporation and have a medical reimbursement plan. Only a C corporation or an LLC or a Schedule C, like probably most of you are.
So why would 3 different accountants say, well, I don't know?
They're stupid.
Okay.
They don't specialize in self-employed people like I've been doing for 30 years. Since my 21st birthday, and I opened Taxmasters, that's all I've ever done is realtors and people who are self-employed. Okay? Doctors, lawyers, but specifically realtors. Okay? That's why of all the people in the country, you know how many tax experts are in the country? We do more plans than anybody in the whole United States. Okay? Why not?
What
Okay.
about if there's 2, like one LLC and one C Corp in the family, or 2 LLCs?
Fine. Just one, whoever really helps the other is the one that should hire them. Okay, so it depends on who's doing the work. If you help your husband more.
But aren't
he
they going to
helps
have to claim that reimbursement as income on the outside?
No, a reimbursement is never taxable. Let's say that there's no toilet paper in the office. So you run out and get some toilet paper. You come in and you say, Mike, you owe me $3 for the toilet paper. He reimburses you. He deducts it. You don't pay tax on it. Reimbursements are never
So we
taxable.
could still hire like an LLC of a company.
You can hire, it has to be a person.
Oh, my husband.
He's an LLC. Right, absolutely. LLCs work fine. The only thing that doesn't work is an S corporation. Okay? But nobody knows this. Big. Okay. If you have any questions, you ask Marty. He will talk to you. This is the last subject I'm going to cover. Okay, you're awake back there. Where is my thing? Usually I have like 50 people in the room, and when I start talking about retirement, people's eyes, they just glaze over. Because people say, I'm not going to retire. Well, I know I'm not going to retire. Who here wants to retire? Don't retire. You get rusty when you retire. You're not going to retire. No. You don't get to deduct your car if you retire. You can't deduct your cell phone if you retire. Okay, don't retire. Don't retire. Okay. But we live in the most wonderful, powerful country in the whole world. I apologize. I know you're foreign born. But there's a reason patriotic, but we need to be ashamed of ourselves. The deplorable fact, and it's a fact, is that 95% of every retired person in this country today cannot live on a month-to-month basis without a check from welfare, their church, their children, or Social Security. Now, when you get older, do you want to live off of your children or your church? How about welfare?
You got started.
How about Social Security? You know what the average Social Security check is? Under $1,000. Yeah. And you know it's going to be much less when you folks retire. Okay, you're going to listen to me.
Exactly.
You're going
You owe us.
to listen to me. That's right. You're going to listen to me, and you're going to do what I tell you. You are $50 a year. And if you spend $50 on something deductible, how much does it cost you? Half, 25, that's right. For $25 out-of-pocket cost per year, you are going to open up a solo 401k. Now listen up. This law was passed in the year 2000. It went into effect in 2001. This is not a new law. And I bet you no one's told you about it except me, because I did speak about this the last time I was here. Do you remember it? If you don't, I'm going to hear it again, because it may be about the third time you'll listen to me. In 2001, when this went into effect, Congress was trying to protect you from unqualified plans. Congress said, oh my gosh, we forgot to give self-employed people the right to have a qualified plan. Now, I'm going to tell you the difference in a minute. But just from the sound of it, tomorrow you have to go to the dentist. Your filling fell out, and he's going to have to drill. And this door is doctor qualified, and this door is doctor unqualified. Which dentist are you going to go to?
The qualified.
Yes. Okay, so Congress, 14 years ago, actually 13, I guess, passed this law to protect you so you would go to see the qualified plan. Okay? Now, if you have a solo 401k, how much money can you put into it? You don't have to put in anything. If you don't want to, you just transfer your old money into it. But if you want to put money in, you can put a lot. You can put in 20% of whatever your net earnings from real estate, whatever it is, plus $17,500. Now, if you're over age 50 like me, I know you can't believe it, right? Mike, you can't believe Sam, you can't believe I'm over 50. Oh, thank you. Okay, so if you wanted to, let's say that I did Sam's taxes. And Sam, where did I lose it already? Sam, you made $300,000 from real estate this year. Yay! He's your top producer or something. No, your top producer probably makes $800,000. So I did your taxes, and I got your income down to only $100,000 left to pay taxes on. And I think I did a good job, didn't I? And he says, no, Linda, I don't want to pay taxes on $100,000. I say, okay, we've got the last-ditch effort. We're going to have you do a solo 401k. Well, how much can you put in it? Okay, what's 20%? Come on, people. Okay, and you always can put in $17,500. So now how much can he put in? Okay. Now I'm over 50. Are you over 50? No.
Yes.
You are? Okay. If you're over 50, on top, whoops, 5,500, you can make it 43,000. Did I do that right? So out of 100, you can put away 43 if you wanted to. Okay, I have a client, she's 83 years old, she works for Lauren and Foster somewhere else, and her husband's a general, and she makes a lot of money because she gets a lot of referrals. She's been doing real estate for 40 years. Okay, they don't need the money that she earns from real estate. She puts $43,000 every year into her retirement plan because they don't need it to live on. Okay, and if you have a 401k, you can contribute after you're 70 and a half. Okay? With anything else you can't. Now, remember we talked about doctor qualified and doctor unqualified? Get ready.
Not that I can do it.
Get ready. You don't have, who here has an IRA? Put your hands up really high. Okay, on the first page here, I want you to write something. Linda spanked me. Just write across here. Linda, in big letters. Yes. Linda's, yeah, usually the guys write it, but I want you to really spank it. Okay, on the front page, if you have an IRA, put on there, Linda spanked me in big letters. okay. You wouldn't have a surplus. The law was changed in 2000, year 2000, to protect you from these plans. Would you like to know the difference between qualified and unqualified? Okay, I want you to hold on to the chair like this. Hold on. I'm serious because you're going to faint. Say this with me. A qualified plan is a little fella. Come on, little guy, you can do it. A qualified plan is federally protected 100% from what? Creditors, lawsuits, and bankruptcy. An unqualified plan is not. A qualified plan allows you to put in the largest amount. How much can you put in an IRA every year? 5,500 is the most you can put in. And you have to put it in by April 15th. Wouldn't you rather put in 37,000 or something like that if you wanted to? Okay, a qualified plan allows you to borrow money from it. You can put money into your qualified plan, your 401k. Today, you can take it out tomorrow and use it to buy real estate. How many of you have self-employed clients? How many of you? Everybody put your hand up. You all have self-employed clients. Sometimes they want to buy property. Sometimes they need more cash. They can take it out of their 401k. They get the property, you get your commission. I'll show you how that one works. If you borrow the money from your 401k, you have to pay it back within 5 years if you're just going to take the money. Sam wants to go to Las Vegas, wine, women, and song, fine, take it out. Not for my client, but anyway, take it out and you got to pay it back within 5 years. Let's say Gail wants to buy her own home, then you have to pay it back within 15 years. Okay? Now, there's no penalty, no tax when you take the money out. You can take it out at any age, so you could be young and buying property. You have until October 15th to put the money in. A couple of weeks ago, I gave a speech up at one of your competitors up in Frederick, on the Ballantrae Road or something. I was teaching for the Academy of Real Estate, so I really wasn't for one of your competitors. They would just use their room, which is not as nice as this, by the way. Nothing's as nice as this. And about a week after I gave the speech, one of the ladies who was in the class called. She wasn't my client. She says, Linda, I wasn't paying attention, but you talked about the K plan and being self-employed. And she says, I'm about to lose a deal. Maybe you can help me. And she said that she had this young couple, and the husband was self-employed for like the past 2 years, and they were trying to buy their first house together, a married couple, about 30 years old. So I said, just give me their phone number. So I called up the husband, and he said, yes, the bank or the mortgage company want me to come up with more down payment. You know how they discriminate against self-employed people, right? Mm-hmm. Right, okay. So, well, not discriminate, they just hold you to a higher deposit amount or whatever. So I said, well, how much do you make? He said, well, I'm making $109,000 a year right now. He says, I'm a government contractor. I'm working for the IRS right now. He said, but up until 2 years ago, he says, I worked at Oracle Corporation over in Tyson's Corner. And I said, oh, when you were at Oracle, did you have a 401k plan? He would say, they have them for big companies. He said, yes, and I used to contribute the maximum to it because that was before I got married. So I said, well, how much was in the 401k plan when you left there? He says, I don't know. He said, but they told me I had to leave it there because if I took it out, it would be taxed and I would lose all the money and it was a big mess. I said, well, can you call him and find out? He said, oh, I can do better than that. So I could hear him on the phone. None of that. Oh, my God. Oh, my God. I said, what's wrong? What's wrong? He said, there's $40,000 in that account. When I left, it was only like 20. It must have gone up a lot. So I said, fine. So I talked to Mark in my office. I got him on the phone for the next minute. Now, Mark in my office is a certified financial planner. I am not a certified financial planner. I am a tax person. But Mark is certified. Mark faxed over to the young man a little form which he signed, which then was faxed over to where do you think? Oracle Corporation. And they wired the money into the young man's new
401k.
That's right, the new solo 401k. The next day, the gentleman took out $20,000 and he walked into the bank and said, I have another $20,000 for my down payment. Now can I have the house? A couple of minutes later, I guess, the young couple calls me on the phone. Linda, you're going to be our tax accountant for life. We're going to name our first child after you. I hope it's a girl. We got this date. We got the settlement date. It's all set up. I hung up the phone. The phone rings again. It's the lady who in my class. And, you know, a lot of times people ask me favors all the time. We answer questions for free all the time. And nobody ever bothers to write back or email or call or thank, but she called me back. And she said, thank you so much, Linda. We just got news that the settlement's been set up and everything's going through, and the couple is so happy. I said, yes, and you're going to get your commission, which is what I was all about in the first place. So, you know, I was driving home that night, every night I drive home there, and I was thinking, I have the best job in the whole world. I just helped the young couple get their house. I helped the lady get her commission, and I got a couple new clients out of it. But you have clients who are self-employed. Just now I had another realtor from Long and Foster, she's with the Gateway office. When I explained this to her, she had an investment property she was trying to sell, and she had a couple, they each took $50,000, they're both self-employed, they each took $50,000 out of their solo 401k, and they're putting it as the down payment. So they're getting a really low mortgage rate on the investment property. So here's how it works. Watch. Who here is thinking of buying an investment property? This is the last thing we're covering. Come on, who wants to be my guinea pig? Huh? Come on.
Not me.
Oh.
I can be.
Oh, Milena, yeah. Okay, Milena, you missed the class today. You weren't here. Oh, I'm so sad. Here's the deal. You are getting ready to buy an investment property. You found a really nice little townhouse or condo or something like that. And you need an extra $10,000 to take to the settlement because you don't have enough cash in your regular account. So you walk into your stupid bank that has your stupid unqualified IRA, or maybe it's at a brokerage company, and you take out $10,000. What immediately happens when you take money out?
Penalty.
Yeah. Well, are you under 59 and a half? Are you? You have to pay a $1,000 penalty, 10% penalty. You have to pay 8% Maryland tax, 10,000, 8%. You're at least in the 25% tax bracket. So you add these guys up, that's $4,300. Now, you're probably, are you married? Mm-hmm. Yeah, okay, so you're probably in the 35% tax bracket. So this is $5,300 tax. You owe right now today on that $10,000 that you took out of your IRA. How much is left to go to settlement? Only $4,700. She can't afford to go to settlement. Now, aren't you glad you're here today?
Yeah, I just took my 401k question.
No, you took it out?
Yeah, I did.
Was it in the past 60 days?
No. September.
Oh, if it's within 60 days, I could roll it over. Oh, God, I'm going to cry. Okay. Oh, okay, but you're here today, and the good news is, for the future, you will never take money out of your IRA. You will take all...
Although it was not IRA.
Or your
my employee.
Your employee 401k. It's the same as taking it out. Okay, so from now on, all of you here that have an unqualified plan, where are you going to roll it over to? You're going to roll it over to your solo 401k. You're going to loan yourself the $10,000. You have the whole $10,000 to take to the settlement. Now, you have to pay yourself interest on the loan. You don't have to pay any principal. Forget about the $200 a month. You don't have to do that anymore. You just pay yourself 5% interest for the next 5 years. Or if you're buying your own home, Milena, you can loan it to yourself for 15 years. Now, the interest is not deductible because you're paying it to yourself, but the interest that you're paying means that your 401k continues to grow. Over there, did your IRA continue to grow? No, it's dead. Not only is it dead, you lost all that tax. Let's see now, which is better? Which is better? How about buying a car? Yes, Mary Beth.
I called my accountant, or my financial advisor last week about that. So I said, why don't we put my SEP into my solo, into a 401k? They said at my age it wouldn't be advisable.
No.
Yes, they
Let's-
did.
okay,
I
I
said
know-
because you can deduct that and what you put into it on your taxes now.
No. Let's just say, for instance, that somebody is 70 and a half. It doesn't matter. At any age, every dollar you put into your SEP is deductible. At any age, any dollar you put into your 401k is deductible. However, at age 70 and a half, you may no longer contribute to a SEP or an IRA. At 70 and a half, you can go. I have 90-year-old people that are still working. As a lawyer, it's wonderful. he's so cute. He's about this big. You can still have a 401k. Why would you want your money in an account that's not 100% protected from lawsuits, creditors, and bankruptcy? And I'll tell you another reason. They probably don't handle solo 401ks. And be careful, because even if they do, they probably charge $1,000 a year. Now, the one that I have, and I don't sell them, I don't make any money on the 401ks. The fact that Mark is with me, he's only with me because he got me 23%. I got 23% on my investments with him last year. I can show you. It's because I trust him and because he is the only one I could find who would give my realtors the $50 fee. Now, if you're a lawyer or a doctor and you come to our office, we charge them $1,000. Okay? But the realtors, I said, no, you are not going to charge my realtors a full fee. If you will give them the deduction, I will send you all my realtors. And that's what I've been doing for 13 years. But your people are wrong. They're 100% wrong. I would be happy to call them because I love being right. Because I'm always right.
I'd like to ask you to do that.
Happy. As a matter of fact, I'll probably call them and have Mark on the phone because he's a certified financial planner. They might not believe me. I can quote chapter and verse of the Internal Revenue Service Code, but he can quote that. No, they're wrong. Now,
So are you saying if you roll your IRA or into a solo, you don't have to pay taxes?
correct. The rollover is just a rollover. In other words, it's from
Until
one
you start
institution.
drawing it out.
Until you start taking out. No matter what happens when you're 70 and a half, you have to take out about 3 or 4% of what's in your account. So here's the difference. Let's say that somebody, my lady who's 83 years old, she puts about $40,000 into her retirement every year, but she has to take out $4,000 every year. Okay? But if she didn't have a 401k, she'd still have to take out the 4, but she wouldn't be able to put in the 40. Which is better, a $40,000 deduction or not a $40,000 deduction? This is another thing. Don't ever pay cash for your car. What you do is you put the cash into your solo 401k and you loan yourself the money. Here's the difference. When you buy a car, the most depreciation you can claim on a car each year is $3,000. Okay? And I keep losing it. There it is. Okay. So if you buy a car, here's the car, C-A-R. You have $30,000 that's sitting in your account right now, and you're going to go and put it as a down payment on your dream car. Okay, the most you get to deduct is $3,000 depreciation. D-E-P-R-E. If you had put that $30,000 into your 401k, we deduct the $30,000. Now you loan yourself the money from the 401k and you buy the car, and we deducted, how much have we deducted now? Huh? Let's see, which is better? Which is better, 3,000 or 33,000? Just remember, Linda's always right. Okay? Okay, questions? Huh, did I run over on time? I bet you I did. How much? What, no, what time? Oh, like 4 o'clock. No, never have a watch that's a Rolex. It doesn't tell me what time it is. I'm going to stay and answer 11:19. Oh my gosh, I'm way over. Sorry. I will stay and answer questions, especially from the rookies if you have time. Does anybody want to know? Well, first ask questions and then I'll ask you questions.
I have a question. I forgot what it is.
Okay, you're going to have Robert call me so I can help.
I am. Well, I wrote that to you, yes.
Tell him if he came to my office, I would sit on his lap and I'd say, your wife asked me to explain to you why she wants to have.
And that's how we keep his attention, anyway.
So how far can you go back, like, if you need to?
Big something?
Yeah.
3 years.
Right.
But if it's a medical reimbursement plan, you can't go back. You only go back the first day you hire the person. So if you were to hire your spouse or if you were to open your corporation, it would be as of February. You can go back to all your January insurance bills and deduct those. This is what we did for the gentleman who came to see me last November, and he had the little twin boys. We went all the way back to January for all the insurances that he had paid. He's just getting ready to put orthodontia on the
I'm just thinking about that, looking at this stuff I never deducted.
Well, but who did your return?
I don't even ask. big time accountant up in Bel Air that one year
Hey,
he
Jack.
forgot the
Fred
10,000 I had to repay, and
I hope they paid the penalty.
oh, yeah. So I still had to come up with 10,000.
Okay, that's just sloppy.
Yeah.
I mean, nobody's looking at their work. Okay. More questions?
No, I'm good right now, I just haven't called.
Yes. Yes, Sam?
If you're self-employed and you hire your wife who works for like the government,
Yes, fine, you can do that.
and she's obviously carrying the insurance.
Yes, no problem. You
And
won't
it's
be
auto-
reimbursing her for
she
that.
she gets automatic deductions for her insurance. Now, can you still claim that cost?
What happens is, let's say that your wife makes about $80,000 a year, and on her W-2, it only shows up as $72,000 because they've already taken out the $8,000 for your medical insurance. So you can't reimburse her for that insurance. What you can reimburse her for is all your dental, all your glasses, all of your co-pays, all your prescriptions, anything that's not covered by the insurance.
Okay.
Okay? This works out really good if you ever have kids where they have to put braces on their teeth,
Right. Understood.
or if it's just glasses. I just got new glasses, they're $600.
Yeah, that's why I just sent that much.
Yeah, it's all deductible as a business expense. And go, did you get them in this month?
No, it's not good.
Because if you hired your husband before the end of February, we could go back to the beginning
Yeah,
of
that
the
would
month.
be good, wouldn't it?
Yeah, and tell your accountant, your accountant to read the tax law from 1953. Yeah. Does anybody want to know whether they should be an LLC or a corporation? Or, I like LLCs. It's a limited liability company. It doesn't mean it's a corporation. But it's a brick wall around your assets. Now, I'm not a lawyer. My daughter Gia, who's Miss October in here, is a lawyer, and she will tell you the same thing. But basically what happens is it doesn't save you anything on your tax return. All it does is protect your assets if you were to ever get sued. Now, I've told you that I'm an expert witness for realtors who get sued. By the way, I only work as a defense on the realtors. I've been asked many times to work against them. I won't do that. Of course not. I'm going to sleep at night. But in any case, if you have an LLC and you get sued, they can't take anything away from you except what's owned by your business if you're being sued for business reasons. Or if you own, how many of you own a rental property? We talked about this. No, your rental property should be in an LLC. It doesn't cost anything to do it. There's no transfer taxes or anything like that. You just pay the lawyer to set it up. You have to pay the lawyer to set it up, and it's $300 a year with Maryland to keep the name registered. But I would never own a rental property that wasn't an LLC. For instance, I'll give you a real life example. When my daughter Gia graduated college in 2001, she wanted to go to law school, of course. She always wanted to be a lawyer. She was born to be a lawyer. She's the youngest of my 3 kids. She loves to argue more than me. Anyway, God, can she argue? She's also a good mediator. She's a divorce lawyer, by the way. She got me the last divorce. She's a good one. Anyway, but she also does business law. So we jumped in the car. She's going to Baltimore, to Boulder, University of Baltimore, UMBC, whatever it is, Baltimore. I don't know, the law school up there. And we drove around within a half an hour of the school and found some nice areas where we wanted to find a townhouse or a condo for her to live in for 3 years. And I didn't want to pay rent. Why would I pay rent? I'm a real estate broker, right? I don't pay rent. So I said, okay, Gia, this is a nice area. We're going to stop at the first Long and Foster office within this area. And she said, but Mommy, you're a real estate broker since I was born. You could write up the contract yourself and you'd save the commission. I said, Gia, the last contract I wrote was the Chevy Chase Medical Center. It was a 4-page contract, including the leases. I said, my clients and my students, they tell me it's like 40 pages to do a little house now. I said, you realize that's 40 pages where I could make a mistake and I could get sued? She says, well, you're right. So we walked into the Pikesville office. It was manned by Beverly Rosen. And, well, she wasn't at the front desk. But the lady at the front desk, I said, hi, could I speak to your manager, please? I have a little situation I need to explain, and I'm going to ask her to figure out who can help me. So Beverly comes marching out, and I said, hello, Miss Rosen. I have to tell you something. My name is Linda DeMarler. I'm a licensed broker in the state of Maryland, and I'm stupid. She said, what? I said, I'm a tax lady, and I don't know how to to write a contract, and could you please assign me somebody? And you don't have to give me any commission or anything, because I don't know how to participate. I wouldn't even know where to begin. I don't know how to do anything. And she says, oh, I heard you on WBAL radio. I had just been on an interview a couple months earlier, and she'd heard you all. So she put us in her car, showed us 3 little townhouses. We ended up buying the first one because, sometimes you fall in love with the first one. Always show the people the first one, the best one first. Anyway, it was a nice little end-unit townhouse. So we bought it for $135,000. And it was perfect. So then I call out Mark in my office. I said, Marky, I need $35,000 out of my 401k plan. He says, well, you're really lucky. And I said, why? He says, because you're only allowed to borrow half of what's in your account. And you've got about $80,000 in there. So what was half of 80? 35 was enough. So he says, where do you want? I said, just transfer it to my checking account. Okay, so the next day it's in my checking account. So I'll just let it sit there in my checking account for a couple months or something, and then we're getting ready to go to settlement. No, and then I have to go get a loan. Oh, that's right. So I had to go get the loan. Oh, yeah. So I go to get the loan, and I go to see the loan lady, and the loan lady says, you came very highly recommended by your client who works here with us and all that, but what are your assets? And I said, well, I have this, here's my credit report, and here's the statement from my 401k, and it shows $80,000 in there, and it showed like $50,000 or something in various mutual funds, and it showed $35,000 invested in a bond at 5% interest. Where was that money really located? It was in my pocket. So I'm looking really rich to you. I've got like $40,000 in my checking account, and I've got $80 here, and I own tax match and all that. So you gave me a great loan, because I said it's my second home, right? It was my second home for my daughter. So I got a really good loan. So everything went great. 3.5 years later, my daughter graduated with honors from school. She passed the bar the first time around. She's so smart. She was the youngest person in the room. I'm so proud. And I called up Beverly. I said, Beverly, it's been a wonderful 3.5 years. The house worked really well. Oh, by the way, the day after the settlement, I put it in an LLC. I changed the title. Linda DeMarler owned it the first day of the settlement. The next day, it was in the name of an LLC. Why? Because my daughter was going to live there. We already found a young man who was going to rent the basement. I had to put in a bathroom down there for him. And one of her girlfriends from law school was renting in one of the upstairs, 3 bedrooms upstairs, so the second largest bedroom. So I was going to have 2 tenants in there. Now, who was going to be coming there for parties? Not parties. What are they called? Study groups. Study groups. All these law students. And what happens if one of them gets drunk and falls off the deck or something? I'm going to get sued. So I put it in the name of an LLC, which meant that if something went wrong and somebody got hurt, the most I could have lost was what? Just the $35,000 down payment, because I had a loan on the rest. Okay. So I called up Beverly 3.5 years later. I remember I was driving, and Beverly's so smart. This was just before she retired. This was 2004, so she was still there. And I said, Beverly, now could you assign me somebody in your office to sell the little property? Because my daughter's going to move down to Bethesda. She's got a job at Stein Sperling, Bennett de Jong, and all this stuff. And Beverly's smart. She's smart. She says, but Linda, what if you sell it and there's a gain? Wouldn't you rather have us find you a replacement rental property down in Bethesda where you live, or in Rockville near your office? She's smart, right? She's saving me tax, and she gets 2 commissions, right? She's not dumb. We love Beverly. And I said, oh, Beverly, I don't want to be a landlord. And my daughter's already found an apartment that she's going to rent that's near her office and all that stuff. And I don't want to be a landlord if I don't have one of my kids living in the property. She said, well, would it change your mind if I told you that there's going to be a gain involved when you sell the property? I said, no, it's okay. Even if there's a gain, I still had a loss left over from my 3rd ex-husband. It's one of those losses you only can take $3,000 a year. Okay, bottom line. She says, well, are you sitting down? I said, yeah. She says, well, you paid $135,000. How does she remember these stuff? How does she? You folks are amazing with your numbers. I remember people's refunds, but she remember what I paid. I said, how do you remember that? She said, well, we're going to put it on the market for $235,000. I went, ah! Pulled over the side. I said, what? She says, yeah, property's gone up from 2001 to 2004. Well, she got me a $77,000 profit in 3.5 years. You think I wouldn't die for Long and Foster? I love you folks. Okay? So buy property. If you have kids going to college, buy a property. I did the same thing with my son over in College Park. I bought a house on Wellesley Drive. and we made $100,000 on that one. That one I also put in his name, so I didn't have to pay any tax on the gain. Yeah, and that's smart, $250,000, you got the thing. So, taking money out of your 401k is good. You don't take it to go to Las Vegas. Okay? You take it out to buy real estate. But if I hadn't had that 35, if I hadn't been able to borrow that 35 cash out of my 401k, I would have paid rent for 3.5 years for Gio. And then I wouldn't have had the $77,000 to pay off all of her school loans. By then, my son was in law school also, but he got a full scholarship, so I didn't have to pay. But it paid off all my kids' undergraduates. And one of my stepchildren, too. Okay? So, you have self-employed clients. Don't you want to sell them something? Right? Have them call me. I'll explain it to them. Or they could even better, perhaps, to call Mark. Whichever you want. By the way, I have 20 people in my office. 18 of them actually do tax returns. We will answer your questions for free anytime. Either call, send us an email. You don't have to say who you are, or they don't have to say who they're being referred by. If they say they're being referred by Long and Foster, you'll get the fastest answer back, because everybody in my office knows that Long and Foster comes first. Okay. So be an LLC. How do we get into this? Oh, because I want you to be an LLC. If something goes wrong, then the most you can lose is what's the asset. Now, if something had gone wrong and I'd gotten sued the day before I sold the house, I would have lost the whole $77,000. Did you fill out the little thing? Did I spank you? Yes, let me spank you. Oh. Cuccinella.
Cello.
Thank you.
Thank you.
I love your name. I love your name.
Thank you.
Last year.
Yes, you can be self-employed. Have a regular job.
Just Frank.